Hello, this is Derek as well, Chief Investment Officer for Shelton Capital Management, with another Shelton CIO Minute. Today I want to talk about recession, and technically, what does define a recession? Well, by the National Bureau of Economic Research, they define a recession as 2 consecutive quarters of negative GDP growth. And by this measure, we have had 2 quarters of negative growth, so technically we are in a recession. But I think most people would argue that it doesn't really feel like a recession yet. A better way to measure the effects of a recession are through employment. Every past recession has been accompanied by a change in the trend of the unemployment rate. As the economy is expanding, unemployment generally falls steadily. But when a recession starts, unemployment quickly reverses and starts to rise. So by this measure of employment, we're not actually in a recession yet. Unemployment has continued to fall, even though we have heard many different headlines and anecdotes about layoffs or companies reducing their workforce. So the question is this employment measure going to agree with the NBER's definition? Well, one way to look at this is to actually measure the initial jobless claims, which tends to be a leading indicator of the employment rate. Now, it's not perfect and it's a lot more volatile than the unemployment rate, but jobless claims usually begin to rise sometime before we have a change in unemployment trends. And in fact, since the Fed began raising rates in March, we are starting to see a pretty pronounced reversal in initial claims numbers. Now, while it's important to take a mosaic view of the economy, combine a bunch of different perspectives from different sources to come up with a position on where our economic growth is going, these employment data points point to an economy that not only technically is in a recession, but is perhaps starting to feel like a recession as well. Thanks for joining us, and I hope to see you again at the next Shelton CIO Minute.